Hi everyone, thank you for joining us today for the Net Wealth Portfolio Construction webinar series, which is our series designed to help you uncover unique investment and portfolio construction insights from wealth management professionals. I hope everyone is having a great day today. My name is Josh and I'm a part of the marketing team here at Net Wealth. And today I'm delighted to be joined by Clarke and David Keelan, who are the portfolio managers of Ellerston's Australian Microcap Fund. Today's presentation is titled Microcap Companies and Their Investment Potential, and for the next 40 minutes, Alex and David will share with you an outlook for the Australian microcap sector, where the opportunities lie in the coming 12 months, portfolio construction considerations, and how Ellerston manage their microcap funds. Before we get started, I must go through some quick housekeeping items. Firstly, the views expressed in this presentation are those of the author and presenter and do not necessarily reflect those of Net Wealth and do not represent an endorsement of any product or service. Any person considering a financial product or service from Net Wealth should obtain the relevant disclosure documents from our website and consider consulting a financial advisor before making a decision. It is also important to note that this webinar has been allocated 1 CPD point, and the details will be sent to you in a follow-up email in the next couple of days. To get this CPD point, you need to be watching this webinar for at least 30 minutes. This webinar is being recorded, and you receive a copy of the slides and recording of the video along with the email. If there's anything you would like to ask Alex and David from today's session, you can do so via the questions tab in the toolbar to the right of your screen. We'll endeavour to answer as many questions after the presentation. If you wish to share anything about this webinar on social, we ask you please include #NetWealthInvest or @NetWealthInvest. So a little bit about who we are before we begin. NetWealth is an ASX listed company with over 20 years experience and is one of the fastest growing wealth management businesses in Australia. We provide financial advisors and investors with a wide range of financial products and services via our award-winning online platform. Some of our recent milestones include being recognised as the fastest growing platform provider, recording a FUA net inflows of 9.1 billion in the financial year 2020. We achieved the highest overall satisfaction score amongst our users for the 9th year in a row, and ranked number 1 for overall platform functionality for the 5th year in a row, according to research by Investment Trends. In May 2020, NetWealth won Chant West Best Advice Product of the Year for the 3rd year in a row. Early in 2020, we launched our premium service, providing sophisticated investors with a greater range of investment options. As a part of extending our investment options for cost-conscious clients in Accelerator Core, we also launched our range of Magellan GSS funds, which are managed by Magellan and based on the same strategy as their flagship funds. In late September 2020, we also announced our strategic investment in Xeppo, a fintech that specializes in connecting, matching, and reconciling client data from a variety of different advice tech systems. If you'd like to learn more about our recent product updates, you can find them on our website by navigating to the support tab and then product updates. Now on to the main event. I'm sure our listeners are keen to hear from Alex and David, so I would like to now pass over to them to deliver today's presentation.
Hey guys, it's David Keelan here. Apologies for my strange accent. From Liverpool, UK, but been in Australia for 13 years. Just to give you a bit of an introduction on who Ellerston are. Ellerston is a family office style fund manager headed up by our chairman, Ashok Jacob. We generally do the smaller things in life. We like small companies and we like unlisted companies. I've been with the business 13 years and done a variety of roles from hedge funds to Asian small caps to Aussie small caps. Ashok and I sat down around 4.5 years ago and thought it was time we did a microcap product. So put all the microcaps in one place and we sat down to design a product and to build a team. I've known Alex for over a decade, and she's been on the sell side, and there was no better person that I thought to bring along. Over to you, Alex.
Thanks, David. So as David said, I joined Ellerston about 4 years ago. My background, I was a sell-side analyst, and so I covered industrial stocks from microcaps all the way up to ASX top 100 stocks. And what I found on the sell side is the fact that I was just one member of consensus, and these stocks were very heavily researched. At the microcap end, that there were many stocks that were under-researched, and therefore we had the ability to actually go out hunting and find new ideas that were much better and much more more interesting for us to go and plan. So when David and Ashok offered me up the opportunity to come out and join the microcap team in its inaugural year, it was a no-brainer, and I jumped at the chance. So before we kick off into the meat of the presentation, we thought we'd just put up a poll. And so it's a bit of tongue-in-cheek here, but we think microcaps is a venturous space and one that we like to be invested in, but there are perils to be aware of and there's dangers afoot, but we think that the rewards really outweigh those risks. And so if you're thinking about booking a holiday and sitting on a beach in Australia with your mimosa, would you use a travel agent or would you book it yourself? However, if you're canyoning in Switzerland or skydiving in Brazil or trekking in the Himalayas, you might want a guide to lead you through this adventure. So if you wouldn't mind just clicking on the poll, whether you would actually like a guide or whether you'd like to go about this adventure on your own. We'll just give you about 20 seconds to do it.
Okay, and I will close the poll now. So Alex and David, the responses were 69% yes, 31% no.
So you obviously like the sound of those mimosas a bit more, that you're liking to sit on the beach. It's a brave journey to go and book those adventure holidays on your own, but hopefully we'll show you over time why having a guide might be a bit more to your liking at the end of this presentation. To get into the meat of the presentation, why don't we move on to slide 4. Sorry, I've gone one too far. So what are microcaps? So this might sound like a basic question, but there's no clear vernacular for what a microcap is, and particularly on a global scale. So in Australia, we define microcaps as under 500 million. If you look to the US and Europe, they'll be in the billions of dollars. So our microcaps are below that 500 million, small caps are around that 350 to 2 billion, mid caps 1.5 to 5 billion, and large caps are that 4 billion plus. And what you might see there's a lot of overlap between those categories as companies go from micros all the way up to large and they transition through those bubbles. What you guys might think of what is a microcap, you're probably thinking it's cannabis, it's biotechs, it's spivvy resource stocks, but that's not what we consider microcaps. What we think microcaps are, they're real businesses, they have real cash flow, they have real earnings, and they have a real reason to exist. And these are stocks that are going to be small companies that get big, and they are going to change something that fundamentally needs to shift, whether it's moving online, whether it's moving from a device type company into a global player, or whether it's providing technology that needs to change. These are all things that microcaps are, and this is why we like hunting in this space. So really, if we now move on to slide 5, we can go through this in a bit more detail. So what you can see here, we've got a couple of stock examples for you of microcaps that have become large caps. If we start with REA Group, or what we might all know as realestate.com, it listed in 1999 and it was an early disrupt that print media. what made it pop was really there was an inflection point with the GFC. If you remember back in the day, for most of you that are my age and older, you got your Saturday paper, you ended up looking at the fact that if you're getting a rental or buying a house, you opened it up, you'd said about what open houses you were going to look at that day. But when the GFC happened, that people were looking around for cheaper alternatives for the advertising. So back in the day, you're paying probably between $10,000 and $20,000 for advertising of your house. And REA provided a product which you were able to get your house out to the market as a whole at a much cheaper price point. And so it was really that inflection point of the GFC where people were willing to risk a new way of selling houses, and it allowed that company to go from a microcap in 1999 to a company that now has over $16 billion of market cap, because there was that structural change and people were willing to test out this new technology. I could tell you the same story with Seek and car sales over the same period, but you get my gist there. If we move to Afterpay, its progression in life happened a lot faster than REA. So it floated in 2017. It's a buy now, pay later. Most of you would have heard of it, and I think now it's become a bit of a verb, a bit like you'll Google this, you'll Afterpay that, and it's a space that the millennials really understood. So when Afterpay was first floated, nobody covered it. It was a conceptual stock that everybody thought might have been slightly questionable. We all liked credit cards, we were comfortable with debt. The millennials have been taught that debt was bad and so was credit cards, and they looked at this product and said, I can basically get my instant gratification. I can pick up a product, I split it into 4 easy payments, and it's a budgeting tool. Some of us older players won't understand what they're thinking, but it really took off. And when you started hearing millennials talk about, I'll Afterpay that, I'll Afterpay this, you knew you'd hit that inflection point. Where the market really took it, the inflection point though, was when it launched over in the US. And the Americans, who have an antiquated banking system compared to us in Australia with 4 big banks, that they're happy to find an easy payment solution. And that's when the broader market and those small, mid-cap and large-cap fund managers actually started looking at this and said, this is a real business. This we need to own it. And so Afterpay, since 2017, has now got a market cap of over 28 billion. It's a top 20 stock. And you would have seen yesterday it announced a deal with Westpac, which really further demonstrated the fact that it's a real business and it's conquered the globe and has now offerings in the UK, Europe, and in the US. If we move on to City Chic. So City Chic is it sells clothes to the plus size woman. It floated in 2015 under Specialty Fashions. It was spun out into its own vehicle about 2 years ago. And City Chic was an underserviced market. So that plus size market, it's worth over $1 billion in Australia, 30 billion in the US, and about 50 billion globally. And when it was in Specialty Fashion, it was lost. That Specialty Fashion wasn't that well researched. And when it became City Chic, it came out, people were somewhat interested, but they were really wondering why I need to own a plus size retailer. When we're looking at the stock, we could see that it was transitioning to a very big online presence. So about 40% of its earnings now come from online. And we thought this was actually going to be very interesting for the market. It also started buying other brands for the plus size category out of Chapter 11 in the US, and that helped accelerate their growth offshore. And so over that time, since 2018, it's now become a $700 million company. So it's transitioned from that micro caps to small caps. And we think it's got tremendous room to keep on growing as it continues to pick up further brands and also continues to build that online presence.
Hey guys, it's David again. I'm here to talk about 2 stocks which have a few similar characteristics. The first one is Megaport. Now, Megaport currently is a $2.5 billion company. Alex and I have known this stock for many, many years. Alex has known it pre-listing as well. This stock was in our fund from the start, and we probably only sold it around 6 months ago. So when Megaport listed, it had a bit of a cult following, and it was harder for the broader market to really understand what Megaport does. Everyone understands what a data center is, but when it comes to virtual cross connects, it's a harder concept to get your head around. We liked the business because we understood what it was trying to achieve. It was solving a problem for an asset-heavy business by using an asset-light business model. The growth was kind of 10 to 15% quarter on quarter, pretty consistent, and the metrics were getting better as the business got bigger. Now, to the broader market, for them to take notice and for it not just have a cult following and have broader institutional support, it needed an event, it needed a moment in time where it made people stand up and take notice. Around 2 years ago, they did a capital raising, and as part of the capital raising, Digital Realty came in for a strategic stake. Now, to put into context, Digital Realty is one of the mid-tier players in the US in the data center space, and they're around $43 billion at the moment in time. They didn't want to take the whole thing. They just wanted to have a 3 to 5% stake so that if anything happened, they had a seat at the table. And what this happened was, this then led big Aussie institutions to sit down and understand what Megaport was and how to value it and how valuable it is to the data center industry. The next one I'd like to move over to is PointsBet. I'm sure all you guys have heard of PointsBet. PointsBet IPO'd in 2009, and Alex and I took part in the IPO.
2019.
Sorry, 2019.
Yeah.
Not 2009. So in 2019, when IPO'd, when you think about sports betting in the US, it's similar to the financial situation. The US is big, it's messy, and in many ways it is behind Australia. And in gaming, gambling is no different. So PointsBet had a really good debut, probably up 25-30%, and then it continued to hit out some metrics. Bearing in mind, IPO'd around $250 million, and it's sitting around 2.2 billion at the moment. It has done a couple of capital raises in there. But what happened 18 months ago was Penn Gaming, which was a $10 billion company at the time, went and took a strategic stake in this business. And then the same thing happens. The company goes from having a cult following to the mainstream big institutional funds start to take notice about what's going on. And this is a similar theme. If we look along the 5 stocks here, 4 of them have big international exposures, and that helps attract them investors to give the investment thesis a bit more credibility.
Thanks, David. Yeah, I'd echo those points of David's, that basically it was either a main catalyst or a structural change made these stocks go from micro caps to large caps, and that's what we spend our time looking for. That we're looking for that catalyst, for that event, for a stock to become sort of underknown to being well known, and we hope eventually to become one of those large caps going forward. If we move on now to the next slide, so we'd like to set the scene here and about what the universe is for microcaps. As you can see, there's about 1,400 listed microcaps on the market. That might seem like a lot, but when you actually remove the specky resources and zombie companies, that number comes down quite dramatically. And also that's impacting that average market cap. So it says on the slide 83 million, technically correct, but the reality is the average market cap for a proper micro is around that 100 to 150 mil. There's also a decent amount of liquidity with around 390 million shares traded daily. So microcaps aren't as scary as you all might think, that there are decent market caps there and there's enough volume for everybody. If we move on to the next slide, I'll let David discuss this for you.
Hey guys, so Alex and I always talk our own book, and we truly believe in our space. We think it's the funnest space, it's the best space, and the space that we want to be involved in. And what we're trying to say here is that we believe that in microcaps, if the risk is managed the right way, you can get better bang for your buck. So you can get better alpha on the same amount of dollars. But as I like to think about it, you can put less dollars in and get the same amount of alpha. We've had a once in a generational crash. I think we all know and we all kind of lived through them 4 or 5 weeks, but the market was down 45% in 4 weeks. To put that in context, the GFC, it took us around 4.5 months to get to that level. Now, from this chart, we can see that the small ords overshot on the way up by a few percent, and then on the way down again by a few percent. But it's all about the recovery. So if I look at our microcap fund, we did a beta of 1.3 on the way down versus the ASX 300, but we did a beta of over 2 on the way up. And I put this down to the fact that in the large cap space, companies are heavily cyclical and they're linked to the cycle. Our companies don't need the cycle to grow, and they can carry on developing in different economic times. Now, on to slide 9, I think is the lead-in. So what we're trying to do here is we're trying to give you the 4 key characteristics that Alex and I believe make the microcap. So we're trying to articulate here what our market is about. The first one, something that I do preach on a lot about, is the risk reward. We've got a good slide coming up soon, but it's the same principle as the one before. It's less dollars in, giving us the same amount of alpha as long as risk is managed in a professional way. Under researched, there's a lot of companies, and there's a little amount of time. Now, some of these companies are researched, but they're not researched by the mainstream brokers or even the mid-tier brokers. Some of them are researched by kind of 1 or 2 man bands. Alex and I probably spend 25% of our time running around the country when we're allowed to, and it's something that we really enjoy. Is getting to know these businesses, getting to know the board and the management, and really going out to see the operations and see what they're trying to achieve. Great alignment. So these guys and these board members, they're not career CEOs. They're not in it for the options. They're in it for the market cap appreciation. We want to back the board and management, and they found the business that develop it. Generally, a lot of time, growth isn't linear, so the business has been through a few hiccups, and they've got there in the end. And the last one is correlation. The best way to describe this is Alex and I can sit there one day when the market's up 2% and our portfolio isn't moving. A lot of our stocks aren't linked to the general economy on a day-to-day basis. We're waiting for catalysts, for events, for updates, for things to happen for our stocks to move. We try and take as little market risk as possible and have as much as stock-specific risk. So let me just run you through these now. So this is, if I was to show you this slide pre-COVID, everyone's risk metrics will be around 10 to 15, but given what's happened, the risk is pushed out. Now, as you can see on the left-hand side there, the small odds is giving you 0.31 return versus percentage point of risk, and the 200 is giving you 0.28. So what is showing here that just by using the small odds index, which is, you know, even for us, it's probably too big, it's getting a better risk return than the ASX 200. Now, if you put in the Ellerston microcap fund in the mix here, it does look a bit stupid, but over the last kind of 3 years, this is what we have done. We've given over double the amount of return per unit of risk versus the ASX 200. And way to think about this is the ASX 200 is full of blue chips, but they're heavily cyclical. Our companies can grow outside of a cycle. Next slide to you, Alex.
Certainly. So one of the points that David touched on was the fact that this space is under-researched. And this is where it allows us to actually go and find these new ideas, or find ideas that the market hasn't fully become abreast of. So when you look at microcaps, there's about 60% of the stocks and microcaps actually have zero brokerage coverage. And when you compare this to the small cap market, there's over 50% of small caps have 3 or more brokers covering the stock. And why do we look at this? There's a couple of reasons. So firstly, when you have brokerage coverage, you also have EPS, or earnings per share, which is what the market looks for, and they look for the revisions of that EPS. And so that drives share prices. When analysts update their numbers or cut their numbers, it drives the reaction to the share price. When you're looking at microcaps with very little research on them, it allows us to actually go out, find these ideas. We have a bit more time to actually understand the companies better, understand the management teams, understand where the growth is going to come from, and understand what the next catalysts are to drive that stock. So we hope to pick up these microcaps, and then over time, as they become small caps, they become far more aware to the broader market, and they'll pick up that analyst coverage, and with that drives normally the next catalyst for the stocks going forward. If we move on to slide number 12, this is all about, we want to be, we're backing the jockey, that we want to actually have average inside ownership. We want the founders to be aligned with our investment. So when you read the textbooks, it will say that you don't want concentrated ownership. But in microcaps, this is very much where we want it to be, that we like the fact that the management team who have built this business from nothing, whose vision has been to grow this, to expand, to build more widgets, to create a global business, to create new global tech. We like the fact that they're still there. We get slightly concerned when they get distracted or when they're starting to move away from the business. We're happy for them to be diluted down over time, but at the start of their life, we think that insiders should have a significant shareholding in those companies, and it means that everybody's aligned to the outcome, and that normally drives share price movement as well as the market cap gaining traction.
Hey guys, it's David again. Talk about correlation to the ASX 100. I've been in markets a long time, and we all speak about uncorrelated asset classes. In this day and age, given the whole kind of US dollar, I do not believe that exists and it ever will. But what I do believe in is that you can have a lower correlation. So as we can see, the ASX Small Ords has around an 84%. But the microcap universe has around a 73-74% correlation to the overall broader market, which I think is great. And it means that these businesses, again, are marching to their own beat, and they don't need an economic cycle as a tailwind. An economic cycle is a help, but they can grow without one. And our portfolio has certainly kind of proven that one.
So just moving forward into like opportunities that we see over the next 12 months, which is probably the more interesting part from your point of view, that so in micros, we believe that there's a couple of things that are going to keep driving these stocks forward. So firstly, globalization. These companies have started locally, they're moving globally. That cycle, particularly in the rate of change of technology, is evolving faster than any of us would imagine. And so we're seeing companies like Afterpay that we've spoken about now being offered over in many countries. We've had A2, that was a local New Zealand business, now Australia, New Zealand, and a big importer into China. It is becoming a big business, and we think there's going to be a lot of companies going forward that are going to fit that globalization chart. We also think that we're seeing structural changes with COVID coming through. So we talked about with REA before about the GFC being the structural change. We don't think COVID's going to be any different. So in recent times, I'm sure all of you have done a bit more online shopping than you did 12 months ago, that you've visited Temple or Webster, Kogan, even your traditional bricks and mortars, but you've bought their online product like Myers, JB Hi-Fi, etc. So the question that many have out there is how much of that is the fact that you were stuck at home and you couldn't actually physically go to the shops, and how much of it is now a new learnt behaviour. So for us, we think that there's actually, while these companies might keep all of that shift to online, we think they're going to keep a lot of it, and this is a structural change going forward. And we think COVID's going to accelerate a lot of these companies, that we would have seen the trend to online, but it would have taken a number of years to play out. This has meant that even the older generation who might have trusted putting their credit card into an online store has had to get used to it, and they probably would have started with maybe Woolworths and Coles, like trusted brands that they know, and now they're more willing to try some of the newfangled brands like Temple & Webster and Kogan. The last thing that we think is going to happen over the next 12 months, or there's going to be many more things than we touched on the slide, but the last one we're going to touch on is mergers and acquisitions. So in times of uncertainty, you see M&A activity pick up. And we also think that the largest stocks are looking for growth, and there's a lot of growth at the microcap end. And we think that in that space, we're going to see companies start rolling out the smaller competitors or companies that have technology or different parts of the business that they need to put into a larger business. So we think M&A is going to be a really big going forward over the next 12 months, particularly where interest rates are at the moment. If we just move on to slide 15 now. So what we're trying to do here is we're trying to discuss how we construct a portfolio. We've told you what microcaps are. We've told you what criteria we look for in microcaps, so that and why we like the space, but how do we get all of that information into a portfolio that you can actually invest in? So if we start at the far left, that investment universe, we talked about the fact that it's over 1,400 stocks. And so we need to narrow that down into something that's more manageable and more palatable to look at. So we have a proprietary screen that we run, and that screen looks for things like, if it does have coverage, it will have EPS revisions and market caps and general movements there. But if it doesn't have research coverage, it will look for things like momentum, volume, anything that might prompt us to have a look at the stock because something might have changed there. And so we narrow down that universe. Then we get to our focus list. So our focus list are companies, it's about 300 stocks generally, and it's companies that we think are looking interesting at this point in time. So we start doing some high level work on it, that we look at the industry that it's in, we look at the management team, we look at sort of the growth opportunities there. And also at this point in time that David and I both had over 10 years in the market and looking at microcap stocks. And with that, it means that we have a lot of general knowledge, so we can get through that focus list pretty quickly because we're covering off on names that we've known for a number of years, or we've seen similar businesses, and so we can understand what drives them and what that catalyst might be. Then we move on to our watch list. So from that 300 focus list, we'll get down to about 100 stocks that we're looking at any point in time. At that point, we do really deep dive fundamental research. Dave and I both like cash flow. We like earnings, and therefore we spend a lot of time on how these companies are going to fund that growth, because working capital is normally a big deal at the microcap end of the market. So we want to make sure that yes, we can look at that profit and loss statement. We can see these big numbers because there's a big TAM out there for them to go and achieve. But how are they going to fund that growth to get there? So we spend a lot of time on the fundamentals and digging through annual reports, looking at competitors, looking at that structure. Do they have a debt facility? How are they going to fund this? Then we get down to valuation. Does it make sense compared to its peer group on a relative basis? And then we look at it on an absolute basis. Does it make sense? And we'll dig into this in a bit more detail on the next slide, sort of the upside downside valuation. And from there, we get to our portfolio. So we like to have 30 to 60 stocks in our portfolio, so 45 on average generally. But when we find a new stock, we need to make sure that it makes sense in the context of that portfolio. So we're looking for that 3-to-1 risk return. And so we might have a stock in our portfolio that's had a really strong run, and that risk return weighting has started to change. So it might now only be a 2-to-1. So we'll start selling that down, and we'll look at these these new companies to come in. And so we might put a stock into that portfolio as a prospect position. So this is, we're getting to know it. We might own 1% of it, and it might be hitting 4 or 5 of our metrics, but it hasn't got that last one. And that one might be funding. So we think it might need a capital raise. It might mean that we need to see one more half or quarter of growth to actually make sure it's sustainable. And then from there, these stocks normally move up from a prospect position to a core position, and hopefully a high conviction position into a catalyst, so we can make sure that we get that alpha when it comes through. The other thing that we have to be really aware of is liquidity. So some stocks we might like, and it comes down to that 3-to-1 risk reward, but the liquidity might be there for us to hold it as a core position, and we might need to wait for that liquidity to improve. So this is how we sort of look at constructing that portfolio. If we move on to slide 16 and to dig into this in more detail. So we're looking for that 50% absolute return over 3 years. So that's 15% per annum for each of our positions. And we're happy to get that from capital growth and also from dividends. So a lot of you are probably thinking microcaps, would it have dividends? These companies, because they have that founder-led mentality and ownership there, a lot of these stocks actually have quite decent dividend yields that they're paying out. And the management team are weighing up between funding growth and making sure that the founder who's been building these businesses, normally on oily rags, is getting a return, because normally at the very small stage of microcaps, they're not drawing a real salary. So they're getting their returns from those dividend yields. So when we talk about valuation upside, so what I said before, we like a 3-to-1 risk reward. And so what does that actually mean? We want the stock to, when we forecast it out, the earnings over the next 3 years, we want to make sure that the upside is 3 times the amount to the downside. The downside we're very strict on, because it's very easy to buy a stock, but when things go wrong, you want to make sure that you really understand that downside. And so you understand whether it is just the market selling it off indiscriminately, or if there's something actually wrong there. When we look at the downside, we not only change our view on what earnings we're forecasting over the next 3 years, but you have to look at things like what multiple are the market's willing to pay. So we not only adjust our earnings, we adjust the multiple, but the other thing that normally happens when you have an earnings downgrade is the fact that, when getting back to that cash flow comment, that there's problems with the working capital. So therefore your balance sheet starts coming into question. Net debt might be higher than you think. And so that downside, we really stress test how low the stock can go, because we want to make sure that the portfolio is in that we can get our best bang for our buck, that best return that we can for the lower levels of risk. We then look at industry structure. We've talked about the management and board alignment, but we always make sure that's there. And the funding ability is basically, do they need a capital raise, or is there other means for them to be able to fund their growth going forward? Because these guys are growing very strongly, and normally it requires a fair bit of working capital. And our final metric that we like to focus on is Ellerston has its own ESG score. What is ESG, for the guys out there that don't know? It's environmental, social and governance. And it's quite prevalent at the large cap end of the market. It's drifting down into the smaller cap companies, and we think it will become far more mainstream in the micro cap end of the market over coming years. But when a company is failing one of those metrics, the E, S or G, it normally means that there could be something else going on inside that business that fundamentally isn't good. So we always overlay an ESG score to make sure that we're not missing anything that could come back to haunt us. After we do all of that, we get to that portfolio construction. We decide what stocks should be in, what stocks should be out. We make sure that we don't have too much exposure to tech stocks or retail stocks or mining services stocks, depending on what we're looking at, that it's a well-balanced portfolio, and we make sure that the liquidity is always there. If we now move on to slide 17.
Hey guys, just here to give you some colour on what our view is on US election, stimulus, and a bit of the vaccine. So for preparation for this, Alex and I have caught up with a few of the strategists from some of the big banks and just try and get a view of what we think and how it's going to affect everyone else. Clearly, at this moment in time, it looks like Biden is a clear winner. And then in the last 2 to 3 weeks, we've seen that there's a high chance of a probability for a Democratic sweep where they get both the House and the Senate. Now, there's a few, that is the mainstream view. There's a few more smaller and more controversial pollsters who think that it is a lot closer and that Trump still has a chance in winning. But we'll wait and see on that one. What we cannot deny, and I think whoever gets in, we're going to see a good stimulus package in calendar year Q1, followed by an infrastructure bill. If the Democrats get in Q3, they will clearly be pushing for more healthcare, probably funded by more tax cuts. Our view is that Biden is great in the first year, but then as the tax implications move on to FY22 and 23, it may have a bit more of a negative impact on corporate earnings because he's got to fund it from somewhere. Then on the vaccines are pretty interesting at the moment. Since Trump started to play with the FDA have tightened up their criteria now for their EAU, their Emergency Use Authority. There's around 193 vaccines in production around the world. Trump's got 6 of them into Operation Warp Speed, and out of the 6, there's probably 2 front runners. Shame for Australia. The one that's linked to Australia through CSL, the AstraZeneca one, is probably third in the race at the moment. Now, what the FDA are trying to do is they want a minimum efficacy of 50%. But given the fact that COVID can be caught more easily than the common flu, really speaking, the vaccine needs to have an efficacy of more like 75. To put that into context, the flu jab that we all take probably has high 30s to low 40s, depending on the season. So we've got AGM season, which is approaching us at the moment, and given that we are all news hungry and addicted to updates at the moment, the AGM season is turning out to be a mini reporting season with companies giving top line, bottom line, and even cash flow updates on what's happening in their business and how they're seeing things as well, as investors get a bit more nervous, and which hopefully this is something that we're not a massive fan of, as the market can get addicted to short-term news flow and sugar hits. So I think this is time just to give you a little cheeky example on a stock that Alex and I have liked for a while and that we've done really well out of. Alex and I sometimes describe ourselves as meat and potatoes investors. We're like real businesses doing real things with a real place to exist in. Johns Lyng was an IPO back in 2017. He had an amazing debut, up probably 40-45%, and at that point we probably halved our holding because we thought it was a bit kind of fully valued. But what happens in our world, and Alex and I love volatility, and we love great situations where there are forced sellers. A fund lost a mandate and the share price was driven down to the 80s. So you're talking a business that was probably sub 200 mil. If you guys don't know Johns Lyng is an insurance rebuilder. So they sit on panels of the large insurance firms and also the insurance brokers, and they manage kind of general BAU. The upside is when we have a catastrophic event like flood, fire, or wind, and they can earn some super margins on top of this. Think of Hamilton Island and how that was completely destroyed a couple of years ago. So what we've seen with Johns Lyng is it's been able to increase its earnings ahead of the market and do pretty well. But at the same time, the stock has been re-rated to a very powerful multiple as small cap investors come into micro cap land and they pick good quality businesses up and they reset the valuation. So that's kind of what I believe has happened here. Slide 19 is some shameful promotion of ourselves. We promoted earlier on our risk return, and this kind of puts it into context on our numbers of what we've achieved over the last kind of 3.5 years. That like nearly 23% return post fees. Market's done 7, so 15% alpha. We've been pretty consistent as well. The chart won't show this, but basically in the 3 years that we've been going, we've had 3 quite large market corrections. So hopefully we don't get one every year.
I think summing it all up, so we've talked a lot about the microcaps, what they are, what we're looking for, but I think the key messages we'd like to for you to take away at the end of this presentation is that we actually think that there's space here for the active managers, where large caps you can go more passive. In the microcap space, you really need to be on the ground. You need to be looking at all of these stocks, and you need to be reassessing your positions in these stocks on a monthly basis, if not a daily basis, because these stocks are evolving so quickly and are changing and hopefully becoming from micros to large caps in a quick time. So what we look for, as we've said before, we're looking for that best risk reward basis, so that 3-to-1 risk return. We like the fact that this space is under research, and a catalyst in itself is as they move through that market cap, they become more researched and more mainstream, and more of the larger cap fund managers can start playing in the space. We like the fact that the management teams have greater alignment in these stocks. We think we're very much aligned with the best outcome for all shareholders with that. And we think there's a lower correlation to the top 100 in this space. So because it's catalyst driven and event driven compared to looking at large caps, which are more cyclical in nature. So that's it for the presentation itself. I'll hand back to Josh because I think we have some questions.
Absolutely. Well, thank you, Alex and David, and listeners. I hope that's provided you with some valuable insights into the small cap sector. We will move across to some questions now. If you do have a question for Alex and David, please submit it via the questions panel, and we'll try to get through as many as we can. So the first question I have here, you referenced earlier that there was over 1,400 microcaps within the market, and presumably that is growing. How do you identify the opportunities, and how are you made aware when they are perhaps such a small company?
Yeah, certainly. So it's quite easy to narrow down that list. So when we get rid of, so we're, as David said earlier, we're meat and potatoes type investors. And so when we get rid of the specky resources, the zombie companies, and then get down to sort of the ones that we can plan, you're probably down to about that 600 or 700. The other thing is that because of our background, because of Ellerston's DNA, we have always looked at the smaller end of the market. We also do a lot in the unlisted market. So it means that we are seeing companies for a long time before they become public. And that helps us to understand not only the company specifically, but the trends that are going to be coming forward. And we have a dedicated team here that only looks at microcaps. And so it means that between our corporate memory from being in the sector for so long, the fact that we have a network of people that can help us out in terms of when we're looking at these smaller companies, we would have seen similar companies, so we can test the industry structure. We can also test with management teams, and when they name one of their competitors, maybe we actually go and start looking at them as well as the company were initially there. And so between all of that, our proprietary screen, we can get that list down to a smaller number. Will we see everything? be over every single stock at that point in time? No, but we're hustling every day. And so the fact that we spend all our work life on this space means that we're well equipped to actually see a lot of these stories going forward.
Excellent. Thank you. The next question, if a micro cap performs well enough to grow from a micro to a small or a mid or a large, when are you mandated to sell the stock?
We're not mandated to sell the stock. What we don't want to do is sell too early. And nobody invests in micro caps to have a perennial micro cap. We want to have a micro cap that goes into a small cap. So sometimes we will sell along the way. You know, we've had Temple & Webster, we've had Megaport, we've had Centuria. These are all companies that started off around 150 mil and then went to billions. As I was trying to allude to John's link earlier, when the small cap guys come down with their $800 billion funds and decide that they want to own one of our names, well, we let them because they reset the valuation and they're the new owners of the stock. When we feel that we've lost an information edge, when we're not the guys that fully understand the stock and the risk return becomes a lot lower, then we start to exit.
Thank you. So you mentioned actually. So does the fund work on a 3-year cycle, or how do you? At what point would you be, I guess, bringing in new companies and perhaps selling positions? And you may have just touched on that.
Yeah, it kind of happens. It happens all the time. What we're aiming to invest over the 3-year view. What we're finding at this point in the cycle is that companies are reaching our 3-year valuations a lot earlier. So we like to keep our sell discipline. And there's always kind of new stocks for us to find. But our best positions are the ones we have kept for that 3+ years that have been with us through the majority of the portfolio, because the compound effect is extremely powerful.
And over the last year, and especially through COVID, has there been any businesses or industries that have got you sort of really excited that there's either been a huge growth in that you've sort of had your eye on?
I think online is clearly one that's really exploded with COVID. That we've seen like Temple & Webster, while it had a cracking trading up to date, today the market sold it off a bit because of the fact that it's probably getting priced in and rallied 30% into it. But we're seeing those structural changes for companies to come onto the market, and with those online retailers a very interesting space at the moment, and it's a space that the valuation is being reset all the time. And so we don't have the answer there of what these stocks should be valued for over the next 5 years, but we're here to we think that we can have a smaller holding in some of these names, as those valuations at this point in time are looking stretched. But I think that they'll grow into some higher earnings longer term, and we'll look back in 5 years and think that those valuation metrics don't look too bad in the end.
And do perhaps startups ever fall into your consideration, or are you more looking at established businesses?
Australia is amazing because our VC market is generally kind of listed. Alex and I, we love tech. We spend a lot of time doing tech, but we have kind of later stage technology. We're on technology where we can see a pathway to profitability and free cash flow. ARR, we like that kind of $10 million. So if something is a bit too conceptual, we will spend time and meet the company and get to know them. But until we're happy that it is sustainable and we can see it getting to a level of scale, then we will not own it.
And you touch... Sorry, David.
Yeah, sorry, I should just say we'd rather buy the business when it's 30%, 40% higher, and we know what's happening. Microcaps is not a market where you average down; it's one where you average up.
Thank you. You touched on ESG a little earlier. Are there any microcaps that you're currently looking at which really excel across ESG?
I think it's a space that, so as I said earlier, that ESG is, it's very much in the large cap land at the moment, and it's drifted down into the small cap market, and slowly, what was drifting into the small cap market, I should be more specific, and now it's slowly making its way into micros. So what we're seeing in microcap space, it's the governance, which is what the market's more focused on. And that means that are there people selling outside directors' windows, the LTIs and STIs, so the long-term incentive plans, are they fair to all shareholders? Are there issues with the fact that there's interrelated party transactions? Are they paying the auditors too much because they're doing other accounting work for them? Things like that are something that we're looking at. I think for the environmental and the social, that it will come, but it's going to take a bit of time, because actually being able to audit your supply chain and things like that is a lot for these microcap companies to get through, because they're normally using third-party distributors. And so that will be something that that will come over the next couple of years. In terms of other specific stocks that are doing it well, I think they're all trying to do it. Some are trying better than others, and some of them are more progressed on the journey. But we did notice with this reporting season, a lot of them had put in their annual reports that they were looking at providing more information on their ESG metrics, because they know it's something that they'll need to do over time. And so I think if we had this conversation in another 2 or 3 years, it would be a lot more prevalent in our space.
Thank you. And perhaps a question about the fund. How does the Ellerston Microcaps Fund compare to the other options on the market, and perhaps where do you differ?
Everyone's different. Everyone's got their own style. Alex and I have got an amazing peer group and some amazing competitors. Alex and I, we don't go too early stage. We believe that there's a real difference between the VC market and the microcap market. That's probably one. We're not style driven. Being in this market now for 15 years, value versus growth. For Alex and I, we wouldn't understand why you would pigeon yourself. Why you would pigeonhole yourself into one style. We like companies first, and then we look at the cycle, or we look at the style second. We focus a hell of a lot on the risk. As you can see from one of the charts earlier, our risk return is always right up there versus our peer group. We spend a lot of time on where things can go wrong. The last point is we are a true microcap. You're paying a microcap fee and you're getting a microcap product. The average size of our stock is around 200 mil. We haven't got, we haven't got an allocation to small caps in there. We can't drift up as we see fit. We really want to be part of the allocation process.
Thank you. Perhaps two more questions. Are there any commodity or resource stocks or themes that you like the look of at the moment?
So we talk a lot about the meat and potatoes, and we like earnings, we like cash flow. At our end of the market, when you look at commodity stocks, they're very much floors, and so therefore that they have no cash flow and normally no earnings, and burning through money at a rate of knots. And so we're not good in that space. We're not geologists, so how are we meant to know if it's a good resource or not? We like to gain exposure through mining services, because we can look at that cash flow and the earnings coming through. We do take views that every now and then, if we're looking at mining services, we might have a commodity bent to what services companies we pick. We might decide at different points of time that we want more gold exposure. We had 2 great stocks last year, over the last couple of years. One was Pacific Energy and the other was Zenith Energy. And both power companies, remote power companies to mining groups. And so they provided the power on mine sites. And so those two companies on average were about 70% exposed to gold. And so that allowed us to gain our gold exposure through those companies that had earnings, that had cash flow. And when it makes sense, when the gold price went up, these gold miners wanted to mine more and therefore use more energy, and therefore they made more money. So that was a great way to play the gold thematic.
Thank you. And you mentioned earlier, sorry, about the rise of online and the growth of online over this period. Do you have any views on the upcoming Adore Beauty IPO?
Adore's an interesting one. I think it's got a fair bit of flack in the paper for the multiple. It's not a micro cap for us, so it's not on our micro cap portfolio, but we did do a lot of work on it. It was a calendar year number, so the 3.9 times was a calendar year number, and also we believe the run rate they given was pretty conservative relative to the prospectus. So on our adjusted multiples, the 3.9 times actually comes down to around 3.1. But talking revenue multiples is completely stupid. So these businesses have different gross margins. We truly believe that the GP to EV is the correct multiple. We think it's a good business. They've clearly got an amazing evaluation there, but we think it should do okay. The one that Alex and I we have done a lot of work on and we've been involved in is Booktopia. And we led the pre-IPO round in this one, and that one I think will be listing back end of November, maybe. Yeah, around the back end of November. And if you believe the paper speculation, that's sitting there at around kind of 1.5 times sales, and it's grown up in mid to high 20s.
It's a great tip. Good spot to leave it. Thank you very much, Alex and David, for your time this afternoon, and thank you very much to the audience for joining us on today's portfolio construction webinar. Now, for the advisors on the line, there is a CPD point available for this session, and we'll be providing that to you along with a copy of today's slides and recording in an email over the next couple of days. If you enjoy our portfolio construction content, make sure to keep a lookout for our next webinar on exploring the income and total return opportunities in Australian equities, where we'll have two views from Dr. Don Hampson from Plato and Patrick Hodgins from Firetrail. We also have a podcast which is on similar themes to what's discussed in these webinars. We pick the brains of wealth management professionals, and there's a great list of episodes that you can find on our insights page for that series. Just head over to netwealth.com.au